Okay, let's dive into this. Have you ever wondered why, even with all the fancy financial advice out there screaming at us to maximize returns and chase those high yields, literally millions of people still just flock to the absolute simplest, safest option available? Welcome to another Explainer. Today we're unpacking the fascinating psychology of savings. We're looking at that quiet, constant battle between peace of mind and high returns, and finding out exactly why so many folks choose guaranteed safety over pure optimized math.
So it really boils down to this. Is peace of mind actually worth more than high returns? It's kind of the ultimate financial dilemma, isn't it? I mean, pure mathematics will always tell you to grab the highest number. It's totally logical. But, well, we're humans. We're not spreadsheets. We have emotions, we deal with anxiety, and we have families to protect. As we go through this explainer, we're going to see exactly why that feeling of security often completely overpowers the math.
To truly wrap our heads around this, let's follow the journeys of two friends taking very different approaches. First, there's Ravi. Ravi is all about the simple recurring deposit, or RD. He's committing to locking his money away safely in the bank every single month. Then we've got Arjun. Arjun's taking the aggressive route, putting his hard-earned cash into high-return market options. These represent two totally different psychological mindsets, and over the next 10 years, they're in for wildly different rides, both financially and emotionally.
But before we see who comes out on top, we have to introduce the real villain of this story: inflation. Technically, inflation is just the continuous increase in the price of goods and services over time. But what it actually means for you and me is that as prices slowly creep up, the purchasing power, the actual real-world value of your saved money, just steadily drops. It's like this invisible force quietly draining your wealth.
Let's put that into perspective and make it super real. Think about grabbing a simple, everyday cup of tea. Right now, maybe that cup costs you exactly 10 rupees. But fast forward 10 years, and because of inflation, that exact same cup of tea is going to cost you 20 rupees. The tea hasn't changed. It doesn't taste twice as good. But the value of your money absolutely has changed. It literally takes twice as much cash to buy the exact same thing.
And you know, this is exactly where the math trap snaps shut on folks who only rely on safe investments. Picture this. Your super safe bank investment is giving you a nice guaranteed 6% return. But if inflation in the background is running at 7%, you are actually losing ground. Technically speaking, your purchasing power is shrinking year after year. You're proudly saving money, which is awesome, but its ability to actually buy things in the real world is slowly fading away.
So, knowing that harsh mathematical reality, you've got to ask, why on earth do millions of people still aggressively invest in RDs? Well, it comes down to three massive things: guaranteed safety, built-in saving discipline, and absolutely zero fear of a market crash. For small earners, salaried employees, or senior citizens, protecting that capital is everything. They want zero market risk, no daily tension at all. And hey, before we move on, don't forget to subscribe Mukesh Manoharan Studio and share the video with friends and relatives.
Let's zoom in on that built-in saving discipline for a second. Honestly, for a lot of us, saving money is incredibly tough, unless it's just taken completely out of our hands. An automated RD is basically forced discipline. Imagine your salary hits your account on the first and boom, 3,000 rupees automatically moves to a safe deposit without you lifting a finger. Without that forced habit, let's be real, a lot of people would just see that cash sitting there and blow it on a weekend sale. It brilliantly turns small, totally unnoticed amounts into a serious safety net.
All right, fast forward 10 years. Let's see the final scorecard for our two friends, assuming they both invested 5,000 rupees a month. The math here is undeniable. Arjun, who rode the crazy, unpredictable roller coaster of equity funds, sometimes watching his portfolio painfully drop 20 or 30% in a single month, ends up with around 11.5 lakhs. Rafi, sitting there with his steady, boring, totally predictable 7% RD, finishes with about 8.6 lakhs. From a pure numbers standpoint, Arjun easily wins the math game. Now, what's really interesting about this slide is that even with less money in the bank, Ravi feels like he won the lottery. Why? Just look at his real victories here. He achieved consistent savings without ever breaking a sweat. He experienced exactly zero market panic when the economy dipped, and his core capital stayed 100% protected the entire time. For Ravi, being able to sleep peacefully at night was totally worth having a slightly lower bank balance. It just proves financial success isn't only about maximizing returns, it's about your emotional comfort too. But look, every single financial tool has its trade-offs. Let's impartially lay out the pros and cons of RDs side by side. On the pro side, they are exceptionally safe. The returns are guaranteed, they're super beginner-friendly, and they stay incredibly stable during economic chaos. But on the flip side, the cons are very real. You face that huge inflation risk we just talked about. The interest is taxable, which hurts your real returns even more. And at the end of the day, it creates significantly lower long-term wealth compared to equities. So who actually benefits the most from these safe deposits? Well, it makes perfect sense for risk-averse individuals. Fun fact, behavioral psychology tells us that the emotional pain of losing money is actually twice as intense as the joy of gaining it. So avoiding that pain is paramount for a lot of folks. It's also fantastic for financial beginners, fixed income earners who need disciplined savings, and literally anyone planning for a short-term goal, like an emergency fund or a vacation coming up in the next 1 to 5 years.
However, I'm going to be completely straight with you for a second. If you are chasing serious, long-term wealth, or you're trying to build a robust retirement fund to live off for decades, you absolutely cannot rely only on safe deposits. You just can't. The money grows way too slowly, and long-term inflation will quietly eat your purchasing power alive. To really build lasting wealth, you have to be willing to step outside that RD comfort zone.
And that beautifully brings us to the Smart Strategy Matrix. See, the most successful financial planners, they don't just pick Ravi's path or Arjun's path. They take the absolute best of both worlds. You use an RD for pure safety and emergency cash. You use mutual funds or index funds for growth to actually beat inflation. You hold gold for overarching protection, and you use insurance to keep your family secure. It's the whole shebang, a perfectly balanced approach. And speaking of smart strategies, don't forget to subscribe Mukesh Manoharan Studio and share the video with friends and relatives.
Let's just take a quick second to really let this quote sink in. For many families, safe money is emotionally more valuable than high-risk, high-return money. I love that. It perfectly captures and validates the mindset of so many hardworking folks out there. It's realizing that living a low-stress life, knowing your family's basic foundation is totally secure, improves your everyday well-being far more than constantly stressing over high-risk market yields ever could.
So if you're feeling a little inspired to get your own financial house in order today, here is a super simple, totally unintimidating game plan. Step 1, start a small, automated RD right now. Just get that saving muscle working. Step 2, use that RD to quickly build up a 3 to 6 month emergency safety net so you can sleep like a baby. And then, step 3, once you've got that security locked in, gradually start adding inflation-beating growth funds like SIPs to secure your long-term future.
So the crucial point is this: the absolute best investment in the entire world, it isn't always the one with the flashiest percentage return attached to it. Not even close. The best investment is one that you completely understand, one you can consistently put money into without panicking, and ultimately one that helps you hit your life goals peacefully.
Which leaves us with this final, parting thought. What does the perfect balance of growth and peace of mind actually look like for your family? Take the structure and strategies we talked about in this explainer today. Sit down and start having those big conversations to map out your own balanced journey. Thanks so much for hanging out with me. Keep learning, and hey, don't forget to subscribe Mukesh Manoharan Studio and share the video with friends and relatives. Catch you next time.